Good afternoon, good morning, depending on where you are. This is Jay Olshonsky, President of NAI Global, and welcome to our first quarterly webinar update on what's going on in the commercial real estate and the general economy. Today we are happy to have two people that will be presenting to us. One is Maria Sicola, and she is the founder and CEO of Integrated Data Solutions, and she's been a leader in the commercial real estate business for over 30 years, providing strategic intelligence and creating innovative solutions to her clients while working with highly effective cross-functioning teams. She's focused on real estate market analysis, forecasting, and site selection. She has done things with George Washington University, frequent speaker at industry events. She's earned her MBA from Manhattan College and a Master's in Informational Science from Rutgers, and she's completed postdoctorate studies at Statistics and Experimental Design at Purdue and earned a BA from Seton Hall. Joining her today will be Stephen Cochrane, and he is the Managing Director with Moody's Analytics. Steve oversees the U.S. regional forecasting services and the firm's monthly analysis of U.S. macro and regional industry and international trends. Steve has a PhD in regional science from the University of Pennsylvania, a master's degree from the University of Colorado at Denver, and a bachelor's degree from the University of California at Davis. We will be taking questions via email or via the webinar. If you have a question, you can do it on the webinar, or you can send an email to Fierro, I'll spell that, L-F-I-E-R-R-O @naiglobal.com. If you're live tweeting, you can also live tweet and using the hashtag NAI17. So without further ado, I would like to turn the conference over to Maria and Steve, and let's talk about what's going on in the economy, in the commercial real estate business. And certainly in the last 2-3 months, there's been a lot of change. So Maria and Steve, I'll turn it over to you.
Thank you, Jay. This is Steve, and I'll start the session today. And my job is to provide the economic context from which Maria will be talking about the commercial real estate outlook. And the best way to talk about the macroeconomy today is that the economy really is doing very, very well. We've had consistent 2% GDP growth over several years. The unemployment rate is down below 5%. Wage growth is improving. As we've seen in the last few days, equity markets are buoyant. They were both before and after the election. And essentially, the new Trump administration is inheriting a fundamentally very strong economy. And I think the best way to look at this as an introduction is through the lens of the labor market, and this is what I show here on this chart. The number of job openings on the economy, which is the blue line on this chart, we're at a record high in terms of job openings over the last 15 years at least. Hiring would likely be at a record high if there was enough people out there to hire, but labor markets are beginning to tighten, and tighten broadly across many regions of the country. The quit rate is also rising. The quit rate is the green line here. That is the number of people who are voluntarily quitting their jobs to either take another job or to go on to some other endeavor. And when that rises, that's a sign of confidence within the labor market, confidence that there is another job out there, or that one is getting one or more multiple offers and is has a willingness to leave and do something new. So the labor market really is firing on all cylinders and indicates a very strong economy. In my part of this presentation this morning, I have 4 parts to my presentation. First is I want to look at how fiscal policy is changing our near-term forecast. Our forecast has always been fairly optimistic over the next year to 2 years, given what we see of a strong economy that's fairly well balanced. But fiscal policy, of course, is changing things. The second part will be simply to look at some of the potential impacts of the pro-business policies of the Trump administration. Third will be to look a little bit at trade. And fourth will be to break it down a little bit in the U.S. economy into its regional components. So we move to the next chart, and this chart illustrates how we are making our assumptions about the impact of fiscal policy. And I have to say that the forecast right now is more policy dependent, if you will, than I've ever seen it in the many years that I have been doing economic forecasting, because the potential changes are coming along are fairly great, and yet the amount of uncertainty is still high in terms of what's going to be possible and what will not be possible. So the best thing to do right away is to illustrate clearly what our assumptions are about fiscal policy. So we've combined into our forecast assumptions on federal spending outside of infrastructure, and that would be mostly military spending and spending on Veterans Affairs. Those are the two largest pieces of non-infrastructure spending that the administration is proposing. The second would be infrastructure spending, and the third is tax reform. And tax reform we can break up into corporate and personal income taxes, and then the personal, again, we can break up into those for low middle income households and for high income households. The important thing here is that the largest pieces of this are the infrastructure spending and the low and middle income taxes. And the column I want to point you toward is the multiplier column. That's right in the middle. This is the multiplier, the expected impact that such policy would have on the economy. And our expectation is that infrastructure would have the most immediate impact beyond long-term benefits of infrastructure because of the jobs that get created directly because of the investment in machinery and equipment and such that goes into infrastructure development. And among taxes, where 1/3 is corporate, 1/3 would affect corporate income taxes, about 2/3 personal income taxes. So the multiplier on the low and middle income taxes is the highest, largely because for low and middle income households, if there is some tax break, that added disposable income would more likely be spent immediately rather than saved or held on for another day. And so I show this because I think these are good parameters to use in assessing the debate that will be happening in coming months as proposals are actually laid out in Congress, and we see how the shape of these fiscal stimulus plans actually take. And again, the greatest impact likely would be from infrastructure spending and from household tax breaks for low and middle income households. Note that I don't have healthcare reform in here, not that it's not important, but healthcare reform probably doesn't affect the economy as much. It will change the way dollars are spent and who spends money on healthcare, but it doesn't have, healthcare reform wouldn't likely have a huge impact, a direct impact on the economy in the very near term. The impact of most of the fiscal stimulus takes place in the first half of 2018, and particularly because the spending policies probably really can't get underway until the first half of 2018. And what this does do is it makes for a more cyclical economy, which I illustrate on the next chart. And you can see I've got two lines, and I've got a number of charts that will have a blue and a red line. The blue is what our forecast was prior to the election, so this would be our October 2016 forecast. And what I'm calling the Trump baseline is our current baseline forecast. And you can see that this chart showing real GDP growth on a percent change year ago basis. We've always been optimistic about 2017 and into 2018 with the strength of the job market, demand for housing, rising incomes and rising wealth. We've had a pretty positive assessment of what 2017 and 2018 should bring along. But now the shape of it has changed a little bit. We see a stronger growth in 2018 as a reflection of the fiscal stimulus that we expect to be in place by early 2018. But then we also get a little bit of payback in 2019 or 2020 for a couple of reasons. One is that our expectation is that not all of the spending is going to be covered by cuts elsewhere, and so it will some of it will be deficit financed, raising the federal debt. That employment growth will slow even more so in 2019 or 2020 than we would have expected before, because any slack in the labor market will have been picked up in 2017 and 2018. And that also, all this extra spending and extra income will generate a bit more higher inflation through 2018 and 2019. And I illustrate that on the next chart. And particularly with stronger wage growth, there will be some price acceleration in our expectation. Again, we did expect before the election that core inflation would accelerate through 2018, 2019, but now we expect that core inflation might actually exceed 3%. Keeping under 3% would have meant that the Federal Reserve could have been a little more cautious in normalizing interest rates if indeed inflation begins to accelerate, and particularly if it exceeds 3% sometime next year, towards the end of 18 or into 2019, the Fed may have to move a little more quickly on normalizing interest rates. Interest rates do rise. The next chart is an illustration of changes to our forecast for the federal funds rate and for the 10-year U.S. Treasury yield. In this case, the dotted lines are our pre-Trump forecasts, and the solid lines are our current forecasts for the federal funds rate, which is the blue line, and the 10-year yield, which is the red line. And you can see that not a whole lot of change into 2018, but our expectation again is that inflation will accelerate into 2019, that and that the federal funds rate could actually rise to something closer to 4% rather than something around 3% in 2019. Also, you can see that with our updated forecast, the spread between the 10-year yield and the federal funds rate narrows more considerably in late 2019, implying that the yield curve flattens more than we might have expected before the election. This is largely because the federal funds rate the federal funds rate would rise faster than we expected, but because of the strength of the dollar and the strength of the U.S. economy, that the 10-year yield would likely be kept low as investors look to the U.S. for yield. What that also means is that if there is perhaps some kind of rising odds for a recession, we might think that 2020 might be where the odds would be the highest for the next recession, which will happen sometime. And that would be a time when the economy is likely slowing and the yield curve is flat. And if something were to happen and the yield curve were to invert, that would be a pretty strong signal that a recession were coming shortly thereafter. So if there are any risks, they're not in the very near term. In fact, federal fiscal policy diminishes the risks in 2018, 2019, but then 2020 is probably where the odds are the greatest of running into the next recession. But of course, federal policy is adding a lot of positive factors which could help offset those odds, and the idea that the administration is very business friendly and there will be less regulation certainly feeds into a positive outlook for the economy. And the next chart is an illustration of the industries that, at least from the point of view of investors, may very well benefit from deregulation in the coming several years. This is simply percent change in the S&P 500 for these sectors since the presidential election. And this chart was made about 2 weeks ago, so that if we did this today, it would look a little bit different, and the scale would extend a little farther out to the right. But certainly financials, telecom, energy, industrials, these are industries that may get the greatest benefit from deregulation. Certainly there will be an effort at tax reductions, as we mentioned before, and also less regulation in the financial sector. We certainly expect that there will be an effort to pull back some of the Dodd-Frank regulations, maybe perhaps pulling back on the Volcker rule, so that banks have a greater ability to trade on their own account. There might be some easing up on some of the risk retention rules. Certainly there'll be some changes in the Consumer Finance Protection Bureau as well. At least the funding might very well shift from the Federal Reserve to Congress. There is some question about how quickly corporate tax reductions could come into play, largely because the expectation is that those tax reductions would be offset by tax gains from the proposed border adjustment tax. But as the debate reaches Congress, it looks like the border adjustment tax is going to be a tough sell. It may very well still be sold, but it will be a tough sell. And there are also issues in terms of compliance with World Trade Organization fundamentals as well. So I think we have to question how quickly the tax reductions can come into place, given the need to pay for them somehow. Also fairly, I think there will certainly be a lot of deregulation related to the energy industry and environmental regulations. Hence, those industries should do well in this business-friendly environment to come. So federal fiscal policy gives the economy a near-term boost. Regulation gives the economy a little bit of a longer-term boost, could help us get through that 2019-2020 period. Perhaps the biggest uncertainty relates to the potential issues of trade policy, and we can turn to the next chart for this. This is where I think there's the most uncertainty and perhaps the highest risks to our outlook, because we don't quite know how it will play out. This chart simply shows the historical trend on tariffs since 1995 and how the average effective tariff rate has been cut about in half over the last several decades. This will certainly go up, although it's hard to know by how much. The talk is a 45% tariff on Chinese-made goods, 35% tariff on Mexico, goods from Mexico. It's difficult to think that that will be those will be the final numbers. What we have assumed in our forecast broadly is that for all imported goods prices, we've assumed a 5% increase in imported goods prices that would reflect differential tariffs or lack of tariffs based on specific countries, and the fact that perhaps the 45%, 35% numbers might be talking points, but might not actually be the final numbers, if any, that come into play in terms of trade policy. The uncertainty that this creates, though, on the next chart is that the global economy has benefited well, really, for the last 50 years or so with the rise in global trade. This chart shows global trade in goods and services as a percent of global GDP, and you can see that up until the 2008-2009 recession, it marched upward consistently. It is no longer rising. There seems to almost be a structural shift at the moment anyway that global trade is not expanding as a share of the economy. But what this has done is brought many, many countries out of deep poverty and has created markets for goods and services all around the world as well. I mean, not the least China, but India and Southeast Asia, Latin America, other places as well. And so if this pattern of globalization is to end, it's simply hard to know how that will play out in terms of the growth of the global economy and what it means for demand for our own goods and services overseas. There's certainly a little bit of risk in the near term. If we go to the next chart, as NAFTA is renegotiated, simply because a number of metropolitan areas around the country are dependent on trade with both Canada and Mexico. They are largely the auto industry, electrical, industrial equipment, and electronics, and a number of metropolitan areas in the Midwest, in the Southeast, and then of course along the border region as well. Fairly highly dependent on trade with both Canada and Mexico. And if nothing else, there's a lot of the uncertainty being created by the debate and the potential renegotiation of NAFTA adds uncertainty to those economies in the industrial Midwest, particularly there, and in the Southeast, where so much auto production and industrial equipment production takes place. Another risk from the global perspective is what the effect of on the U.S. economy of changes to immigration policy could mean. Immigration is an important component, and we can move to the next chart. Population growth in the U.S. is slowing. Population growth for 2016 was 0.7%, down from about 1% per year a decade or so ago. And about half of that growth is expected going forward from these figures from the Census Bureau to come from immigration. These numbers actually probably are a little high. We're already at 0.7. The Census Bureau is estimating 0.8 through the next 10 years. I think that might be a bit high. But what this chart shows is that immigration will play an increasingly important role in maintaining population growth and thus labor force growth going forward. And if there were no immigration by the time we get to the 2035 to 2045 decade, we might actually have a very, very little population growth at all. Our demographics would start looking more like something like a Germany or potentially even Japan without immigration. We've already lowered our assumptions about immigration in our macro forecast. We've lowered the number of immigrants from abroad from 1 million per year to 750,000 per year. That's our basic assumption right now for the next couple of years in the forecast. This is most meaningful for the Northeast, which is the slowest growing in terms of both population growth and labor force growth. We can go to the next chart, which simply illustrates population growth last year. The red charts are those that had a decline in population in 2016, and for the first time in a number of years, almost the entire Northeast, or a good part of the Northeast, suffered a decline in population. And that occurred because the Northeast suffered a fair amount of net domestic outmigration from the region, and this is illustrated in the next chart. The next chart is the net domestic migration as a share of total population to normalize it. And here again, you can see that net domestic, this would be state-to-state migration, was negative from Virginia up to Vermont. Positive into the Southeast and the West, and that's the traditional pattern of migration. The key about the Northeast is it's very dependent on international migration to make up this gap, to fill the hole. If we go to the next chart, you'll see that the other areas of the country, Florida, Texas, California, Washington, they get a lot of net international migration, which is what this chart shows. The green states have the highest rate of international migration. But so does the Northeast, and the Northeast needs it. Florida, Texas, California, they don't need it as much because they get the domestic state-to-state in-migration. But without international immigration, the effect would be the greatest on population growth and thus labor force growth over the long term into the Northeast. So we can look at the Northeast as being the region at the greatest risk from some potential changes in immigration policy. Next, I just want to show a couple of charts illustrating the broad economic growth across the U.S. The next one shows job growth across some of the major regions of the country. The main point is that the West and the South Atlantic, the West being both Pacific and Mountain West, and the South Atlantic being the green line that illustrates anything from Delaware down to Florida, as being the strongest economies in terms of job growth right now, although they have slowed as labor markets have tightened as well. The rest of the economy is all kind of at the same pace. The Northeast and the Midwest following each other, which is actually not so bad for the Northeast and the Midwest given their slow rates of labor force growth. The East South Central represents the oil patch. That's Texas, Oklahoma, Louisiana, plus Arkansas. And the good news there, the rate of job growth, while it's slowed considerably, it's no longer slowing. It has leveled off at about that same 1% growth rate, and things are beginning to turn the corner as energy prices are slowly beginning to improve. Manufacturing will be a positive factor for much of the country. The next chart shows the manufacturing survey results from the various Federal Reserve manufacturing, the indexes that are produced from Federal Reserve surveys across the country in Philadelphia, New York, Richmond, Kansas City, and Dallas. And you can see that after really 2 sluggish years of weak performance in the manufacturing sector, things are coming back, and coming back pretty quickly. And in fact, if I had the February numbers in here that have come out in the last couple of days, you would see something even stronger. So manufacturing will be a positive for really most of the country, as will home building, and we can move on to the next chart. And this home building is a factor that we've thought would be an important driver of the economy for into 2017, 2018. This is nothing new. Home building is not keeping up with demand, and with the strong labor market and strong wage growth, there's even more demand for housing. At least in the West, we've seen a surge lately in residential construction permits. Not so much elsewhere. I do expect that there will be an uptick this year in much of the country, and it'll largely be in single family more than multifamily, only because multifamily construction has led the way over the last few years, and demand will begin to shift in coming years as the millennials age into that time when they may buy their first home. But that's a good segue into commercial real estate. I want to turn it over to Maria and let her talk about the specifics of the outlook for commercial real estate.
Thank you very much, Steve. So the way I'm going to prepare my remarks for this conference call this morning or this afternoon is I'm going to take a look at some of the survey data that was captured by both NAI Global and by Real Capital Markets. And I'm also going to look at the supply and demand. And as with any forecast or outlook, one of the things that we really need to look at is how did we perform up to this point, and how did we perform last year. So if we take a look at the first slide in this portion of the deck, these are some of the drivers that were identified in the survey that took place last fall. This is this is actually a survey of the NAI members that was conducted by NAI Global. And these are the key factors that were identified in terms of the ones that will have the most impact on the real estate market going forward. A number of them Steve has addressed in his comments and his remarks. So job growth and the opportunity for employment, the election, and now that the election is behind us, some of that uncertainty has been mitigated. And then, of course, the economy and the overall health of the economy were concerns and drivers. And I think that we've had a good backdrop, again, from Steve of where we expect the economy to perform in the next several years and how we expect it to perform in terms of GDP, employment growth, and several other very important factors. Going down the line, interest rates and tax issues, and again, the fiscal stimulus that will be created by the tax reductions in both corporate and personal income taxes. If we go on to the next slide, what we're looking at here is another part of this survey from NAI Global that asked the respondents in 2 particular segments, what is their outlook and how do they feel? So this is really a finger on the pulse, if you will, for those in the market of what they're seeing from clients in terms of the office market, the office leasing market, and the industrial leasing market. And I think you'll see in a minute here that there are some distinctions. So we have a very good amount of folks here that think that the office market is really going to be flat or cooling down in the next 6 months. Over 50% of the respondents feel that they're going to see a slowdown in the office market. Go on to the next slide. Okay, just a minute. My computer is acting up. Okay. Industrial, by comparison, the outlook for industrial, and again, this is not only just an opinion survey, it's a reflection of what the members of NAI Global are seeing in their client behavior, is you have nearly 2/3 of the respondents saying that they expect the industrial market to pick up steam in the next 6 months. There are likely a number of reasons behind that. Some of that because the industrial market has had some pent-up demand. The vacancy rate is at the lowest number in history, and construction is now on the uptick. And again, this concept of reshoring, which has actually been taking place now for a number of years, where the competitive advantages of offshoring have been diminishing. So just wanted to point this out before we actually get into the market numbers and the actual statistics on how these sectors have performed and how they are expected to perform going forward. So if we can then take a look at our next slide. Okay, so I'm going to look at here and point out to you a number of different property sectors and the demand for those sectors. And this is actually a look at supply as a percent of inventory, and looking at the average over the past 20 years, and then looking at it as of the fourth quarter of 2016. So you can see at a glance here, when we look at these 4 sectors, where we've had significant building, again, as a percent of existing inventory, where the apartment sector has had a lot of building, a lot of development, the logistics component of industrial, slightly more than the average over the past 20 years, but construction activity is now also at record highs for that product segment because of the demand. Office we've kept in check pretty fairly well, and we haven't seen a significant amount of construction. And of course, in each of these sectors, there is some variability region to region and market to market, and retail has slowed down in terms of supply. So let's take a look and go into a little bit more detail on some of these specific sectors. And let's go on the next slide and take a look, first of all, at the apartment fundamentals. So this slide is actually taking a look at both demand and supply in comparison to each other and vacancy rates. And then on the bottom portion of this slide, we're actually looking at rent growth. So we're looking at it, again, historically, and then currently, and then an outlook into the future. We can see in the horizontal line there is the average vacancy rate over time, hovering at about 6%. And you can see that in 17, there's still some excess supply in the pipeline. Again, I'll take a look in a moment and show you some of this variability from market to market. And the demand seems to be slowing down as we go into the next several years, as does the supply. But there are some markets that are currently oversupplied, and there are other markets that are not. We'll take a look at that in just a moment. But you can see the pricing and the rent growth is expected to stay fairly stable for the next several years. So let's take a look in the next slide at how this varies from market to market. We have a couple of things and a couple of dynamics going on in this chart that I'd like to point out to you. First of all, we're looking at the units and the number of units that are greater, and this is new supply, greater than 10% of the inventory. The blue line shows the units and the number of units that are less than 10% in terms of inventory growth. So there are some markets, as I mentioned, that are currently in an oversupply situation, especially when we look at Class A in urban areas, where we're seeing double-digit vacancy rates. I think the markets of interest here to point out are those in the blue bars. The blue vertical bars are showing those markets where we could possibly see some new construction and some potential for new construction because the supply has not yet matched the demand. Okay, so let's now go on forward and take our next slide. Okay, this slide is a look at the office market, and again, a historical look at supply and demand and vacancy rates, as well as our expectation, or the expectation that we have for rental growth. You can see here, I think, pretty clearly this chart illustrating how the supply situation on the office side has been kept in check. and we haven't seen as much development in office. There are, of course, exceptions, but we haven't seen as much development in the office sector as we have perhaps in some of the others like apartments. Current vacancy hovering at about 10.5%, slightly below the historical average. And we also have some development in some markets that is going to be perhaps a little problematic, but on balance, the office market is a fairly well-balanced sector. Rental growth is expected to decline over the next several years. Some markets are at full employment, and some markets are also going to have some difficulty in having employees if we do find ourselves in a situation, as Steve was describing, where we have less immigration. So the labor force is going to be challenging. If we look at the next slide, this is actually a look at absorption. So slightly different perspective on demand in the office market segment. Looking at the average annual absorption on the bottom part of the chart over the last 3 years, average annual over 3 years compared to the past 6 months. Those markets that are above the line, the diagonal line, are those markets that have seen some fairly significant absorption in the last 6 months. They are the markets that lag the others to a certain extent in the recovery. We see slowing demand in the markets on the bottom portion of the diagonal line. So let's just take a few as an example, looking at San Francisco, which has seen a slowdown in tech demand of late. And by comparison, we see some markets on the other side of that line that are beginning to see some increase in activity. Los Angeles is a good one to point out, Phoenix, Boston, and so on. If we go on to the next slide, in the industrial landscape, again, we see several different, I think, factors come into play. We are looking at the lowest historical vacancy rate, and in conjunction with that, because of the pent-up demand, we're seeing construction at record highs. There are some markets right now that are perhaps in an oversupply situation, Atlanta, Dallas, just to name a few. But because of this construction and this pretty significant construction that we have in the pipeline, there is a potential for oversupply by 2019 and 2020. The reshoring trend that we're observing is actually a continuation of an existing trend. Those offshore advantages, particularly with respect to labor costs, have been declining. And maybe more importantly, with the advent of e-commerce, proximity to customers is really, really a key. And this is driving some interest and appetite in the logistics sector, especially for inland markets. And these are just a few of the markets to point out as far as inland ports are concerned, where we expect to see some increased activity in 2017 and in 2018. If we go on to our next slide. So when we use the leasing fundamentals as a backdrop, the question then arises, how does this affect, or how do we see the investment market responding to that? And so a couple of, I think, very interesting points on this slide to point out. Yes, activity slowed in 2016 from 2015 across all property types, but 2015 was an anomaly and a banner year in many different respects. There is a portion of this slide in the center which is pointing to the very significant decline year over year from 2007 to 2008, when we were in the midst of the Great Recession. So you can see the steep declines that took place in that year. And by comparison, while we have seen declines from 2015 to 2016, they're not of the depth and of the magnitude that was seen in 08 and 07 to 08. And there's still an appetite, clearly an appetite for investment in real estate. So let's go on to the next slide, please, and just take a quick glance at who were the buyers in 2016. You can see that there was a significant increase from the private sector, while the public sector pulled back a little bit in 2016. And in terms of cross-border, foreign investment is a key in the U.S. real estate investment markets. And some of the reasons for that pullback in 2016 were just that there were a few significant portfolio transactions in 2015 that were being absorbed in 2016. But there again is still an appetite on the part of foreign investors for the safe haven of the U.S. real estate market. Okay, I think we can go to the next slide, please. And wanted to give you a quick glance at what's happening in terms of cap rates. We haven't really seen, interestingly, cap rates increase significantly. There has been cap rate compression, but cap rates have not been rising. And despite rising interest rates, they are remaining fairly stable, and that's across all the property sectors. Move on to the next slide. Just a quick glance here at all the different sectors, if you will, on this graph, showing the volume change from 2015 to 2016, and then the price change over the same period of time. The labels here, just to make some, give some clarity to the labels, 6 major markets. The 6MM refers to the 6 major markets: Boston, New York, D.C., Washington, D.C., Chicago, San Francisco, and Los Angeles, and the NMM, the non-major markets. And if you look on the right-hand side of this chart, this graph, excuse me, you'll see, I think very interestingly, some activity in the suburban markets and the non-major markets, where we've actually seen, if we could go back to that one for just a second. So the suburban markets have become in favor, if you will, and they have become an alternative to the coastal markets and the urban markets. So whether it's the non-major markets CBDs, so suburban office space, non-major market apartment space, suburban, again, suburban office space, even in the 6 major markets, have become an investment alternative. So there's this movement to secondary and tertiary markets and away from the traditional urban core markets. And there's also been in those markets an increase in price as well as an increase in volume. Okay, if we go on, please, to the next slide. This is actually a different survey than one I highlighted or mentioned to you before. This is the Real Capital Markets Survey of Investors. And this is a look at investor sentiment and what the expectations are from an investor's point of view for 2017. So the first survey was of NAI Global members, and it was a look into what their clients are doing on the leasing side. This is on the investor side, and it is a survey of investors in terms of what is the sentiment for buy, hold, sell, and so on. And I think it's clear that there is a significant appetite still for investing. More than a significant part of the survey respondents, more than half, are intending to buy. They may be trending toward hold, but there is, again, this outlook for purchasing in the next year. Let's go on, if we may, to the next slide, please. So where does this leave us in terms of not only 2017, but the outlook going into 2020? The economy is going to remain strong. We saw that, again, in Steve's slides, both in terms of GDP and employment growth. We need the job growth to fuel the office demand. One of the headwinds looking at that is the stricter immigration laws that could slow population growth and ultimately slow labor force growth. Leasing fundamentals are fairly balanced. There is some sign of slowdown in some of the sectors, office, apartments to a certain extent. Apartments definitely Class A in some of the major markets. A little better positioned in terms of apartments in Class B and C space and in suburban markets. The regulatory environment and the fact that we may see some easing there of regulations will favor certain industries, which could really bolster some regions of the country. Defense spending, for example, is one of those areas. We've seen it already in the banking and finance sector with the surging stock market lately. We are not necessarily at a risk at the moment because of increased construction. Again, the industrial sector really, it's a positive sign that we're seeing some development in the industrial sector. It's really needed for warehouse and distribution space, particularly in our inland markets. And so from an overall standpoint, a 30,000-foot standpoint, it does really point out to us that real estate remains an attractive investment alternative. Class B and C apartments in the urban areas, suburban apartments, industrial, most notably logistics, suburban office, especially suburban office in and around transportation hubs, and then some perhaps less traditional sectors such as medical office and data centers are also really sectors that could be becoming significant. And with that, I'll turn it back over to Jay for the question and answer portion of the call.
Okay, so let's move to the question and answer section. And again, if you have a question, you can put it through via the webinar, or you can email it to Lindsay Fierro, lfierro@naiglobal.com. But Steve, why don't I start with the first question, which I kind of understood, but I'm going to read it to you directly, and I'll let you answer it. This question came from one of our panelists, not one of the people attending via the webinar, and it is, quote, "No one is talking about no immigration. The correct topic is illegal immigration restrictions. Why are the two matters conflicting?"
That's a good question. Indeed, no one is talking about no immigration. My point of showing that chart was simply to show, to set some context, some parameters to illustrate how important immigration is in providing the United States a comparative advantage in terms of a continuing growth in the labor force versus so many countries, both in Europe and in Japan, that don't have that advantage of having a lot of immigration to bolster slowing population growth. The risk is not that immigration will be banned, but if the immigration, I don't know what the right word is, if the immigration climate becomes difficult, if it becomes more difficult for persons who want to immigrate legally to the U.S. to come to the U.S., they may give up altogether. Or indeed, if if the environment here deteriorates in terms of how we treat our immigrants, there may be people who actually decide not to stay but to leave. So the main point here is that we want to, the risk is that the environment that keeps the U.S. attractive to legal immigrants could deteriorate based on how these policies are carried out. That's really my main point. The questioner is right. There will never, in the U.S., I think, not be no immigration, but the real point is immigration is really important to the long-term comparative advantage of the U.S. Economy.
Okay, excellent. This could actually be a question for either, just your opinion for Maria and or Steve. Certainly the stock market hit a major league high yesterday, and I guess what would your thoughts be, just say, on the overall stock market, and will it have any effect on, let's say, commercial real estate?
Well, I'll take a shot at that first, and then hand it over to Steve. But I think that what we saw yesterday was definitely some euphoria. I think that there is quite a bit of uncertainty that's been lifted. There is still, of course, some uncertainty with the specifics of the policies that will be enacted and when they'll be enacted. But I think there's some exuberance, most certainly, with regard to tax cuts and declines or decreases in regulations. And I think that that's what's reflected in yesterday's numbers. I think that we'll probably continue to see volatility in the stock market going forward. So certainly I think we were all happy to see that huge bump yesterday for our own portfolios. But I don't think that that means that there still isn't, again, this interest in real estate as an asset class. I think it definitely offers some hedges against risk. I think that the real estate market fundamentals are pretty sound, and I do think that there's going to be, especially on the part of institutions and pension funds, a need to diversify the portfolio. So I see that, again, as I think a moment of euphoria. I think it says, you know, thankfully we may see some tax breaks, we may see some of that money be pumped back into the economy. That's a good thing, but I don't think that that's necessarily a negative for investment in real estate.
Just add, I think one of the remarkable things about the equity markets of late is the lack of volatility, really, over the last few months in the markets. We haven't seen volatility as low as this in, I can't remember when. And so what I think that does mean is that, you know, there's a higher probability we'll have more volatility going forward, particularly as we come to understand how federal policy will be able to make some effective changes in the economy. So we may get used to this lack of volatility. There may be some surprises in terms of volatility going forward if investors get a little complacent. And then, of course, how the Federal Reserve reacts in terms of the pace of normalization of monetary policy could add some unexpected volatility as well. Overall, the wealth effect, though, from where the market is today, I think will have a very meaningful and positive effect on the economy. We have found that if you think of wealth, the wealth effect can come usually either from home equity or from stock equity, if you will, or other investments. Prior to the 08-09 recession, home equity was the greater driver. That growth in household wealth was a greater driver of spending and household investment. Since then, it has been stock equity, which has been had the most significant wealth effect in terms of spending, and I expect that to go forward. And so, as long as the market's up, I think that bodes well for spending from consumers, and then on the other hand, also investment spending by corporations.
All right, staying on that, this question literally just came in, but I think since we've been talking so much about how hot industrial has been in particular in many sectors, the question that comes from an institutional investor is, what effect would a border tax have on demand for industrial real estate?
Yeah, that again is a very good question. I think that, and we didn't discuss that specifically in our slides or in our remarks, but I think that a border tax could really be something that would be detrimental to demand for industrial real estate. I think that, you know, the globalization and the global trade, if we are beginning to see these tariffs rise, could really have a negative impact, significant negative impact, especially on markets that are along the borders, along the coast. So I think that's something we really have to see as potential headwind and something to really monitor very carefully.
Okay, since we're running up a little bit on time, let's put this more into a baseball analogy. I'd like to get both of your thoughts on, we are definitely in a cycle that we can say started in 2009 and we're in 2017 or 2010, and I'd like to get your bold opinion on what inning we're in the cycle.
Oh, that's good way of posing that question. I think we're in the 7th inning stretch right now. We are all up on our feet. We are singing "Take Me Out to the Ballpark." We are looking forward to the next couple of innings. I think the next couple of innings, the next couple of years look good, but we're a little uncertain about what the final score is going to be after the 9th inning. I don't know if that's a very good analogy, but that's my initial reaction. I don't know, Maria, what do you say?
Well, Steve, I think I would say that we were probably in about the 8th or 9th inning we're getting close to the end of the boom, if you will. I think that what's been happening in the election and the new administration has given us a bit of a bump, if you will, and so I think that now we're actually looking at being in an extra inning game, and I don't think that we necessarily were expecting that. So I would think of 17, 18 as our extra innings, and then I think it just is a matter of what happens after that in 19 and 20, and that remains to be seen. But I think we're in an extra inning game right now.
Oh, very good.
Well, excellent. I want to really thank both Maria and Steve today for spending time with us on an NAI Global quarterly webinar call. And we will be hosting these on a regular basis going forward. And I'd also like to remind everybody on the phone that our Global Market Outlook will be coming up in Dallas, Texas on March 21st. It's a breakfast outlook at the Ritz-Carlton, and it is open to anyone that would like to attend. And this year we're very fortunate that our Leadership Board President, Andy Farbman, has gotten Ken Kaplan, the Chief Investment Officer of Blackstone, to be our guest, and they will have a roundtable discussion of similar things that are going on from one of the largest owners and buyers and sellers of real estate in the world. We will also have Mark Miller, who is with our Robert Lynn firm, NAI Robert Lynn in Dallas, talking about the Dallas area, and I will add a few things myself. We want to thank everyone for participating today, and that's the end of our call. Have a great day.